but they also come with inherent risk, making strategic risk management crucial. To share their expertise on this dynamic segment, we have Mr. Ankit Jain, Fund Manager at Mirae Asset Management Company, with over 12 years of experience in investment analysis and fund management. His in-depth knowledge of market trends make him an invaluable guide in identifying opportunities in mid-cap and small-cap category. Let's welcome Mr. Ankit Jain to the stage.
Yeah, hi. Good afternoon, good evening, everyone. Yeah, thank you for this opportunity. So, let me start. Yes, I mean, as rightly pointed by the lady, that mid cap and small cap is a very, very exciting segment of the market. It clearly comes with its own fair share of risk. Having said that, over longer term, I mean, I will try to show during my presentation that how the typically earnings growth to pan out and why it really, spaces become even much more exciting going forward. And we'll also try to discuss some of the themes, longer term themes, where actually we do see, longer term growth opportunities as such. So this will be like, the structure. So first, if we look into, let's say, last 5 years, how the space has evolved, is that there has been a multifold increase into the market cap, particularly in the mid cap and small cap segment as such. Almost 30% CAGR, has been the growth in the market cap. As far as December 19, which is a pre-COVID time, and December 2024, for roughly 5 year average CAGR, if we try to look into the market cap of mid caps has evolved from 22 lakh crore to almost 88 lakh crore, almost 30% CAGR. To large caps has also grown at around 20% CAGR. And the one key thing which has been observed is that if you look into the largest mid-cap market cap in December 2019, which used to be 26,000 crore, that is now even at somewhere at around 270, 280 company, which is like, the largest small cap itself is now 33,000 crore. So there has been a significant jump in the overall universe space, balance sheets of the company, size, scale. Everything has grown multifold as such. Another interesting aspect has been that with buoyant capital market and a lot of IPOs coming in, many interesting newer businesses are sort of getting added, particularly in the mid cap and small cap space as such. If you look into, last 7-8 years, 2016 to 24, almost, if you look into 53 new companies has got added into the Nifty Mid Cap 150 indices as such. So which means that clearly, out of 150 companies, 54 companies currently, are there, which was not even existent, 7-8 years back. So which means that clearly a lot more newer businesses and sort of investment opportunities are coming into the market in the mid-cap space when to invest in. At the same time, if you look into, many newer sectors are also coming in. If you look into many of the sectors which do offer relatively higher earnings growth potentials, are having higher and higher weightages in case of mid cap and small cap. Particularly look into, let's say, sector like cap goods, auto ancillaries, real estate, chemical, and then a long list of capital market, hotels. So many subsectors are there which are particularly part of the mid cap, and many of these sectors really do hold higher earning growth potential over time because of various factors. So that's why at an aggregate, typically mid-cap and small-cap businesses do offer higher sort of earning growth potential over time, and which in a way also do drive typically higher sort of a return potential over a medium term span. If you look into the profit pool comparison, let's say, how the mid-cap share in the overall earning pool of the market is going up. This is like pre-COVID fiscal year 20 aggregate. Number is not the right sort of a thing to look at it. But if you look into fiscal year 24, almost 14% of the BSE 500, let's say profit pool of around 14 lakh crore, 14% was part of the mid-cap. The same number is now has gone up to almost 16-17 odd percent. And as some of these companies do keep on compounding earnings at a faster pace, clearly this percentage share of profit pool, will actually further keep on growing. If you look into over a reasonable time frame, typically mid caps do exhibit pretty good double-digit earnings compounding. if you try to look into this is like trailing 5 years sort of a number. So if you look into this is fiscal year 4 to 9. This 5-year earning growth has been at around 19% when it comes to mid cap. 9 to 14 has been 15%. 14 to 19 has been 14%. 19 to 24 also pretty good sort of a earnings growth. So typically, if you look into at any block of 5 years, which is a reasonably good sort of a time horizon, 1 year, 2 years, there could always be a volatility at any given point in time, or maybe there might be one particular sector which can, which can impact the overall, earnings growth of the indices as such. But if we try to look into on a 5-year bucket, there has been a reasonable history of these companies to really sort of deliver pretty good, healthy double-digit earnings growth. In that context, if we try to look into even the ROEs, of many of these businesses are pretty good. At an aggregate level, 14-15% sort of a ROE, which is a very, very healthy number. And another interesting thing has been that over time, these companies has delivered their balance sheet significantly. So if you look into fiscal year 9, that equity was around 0.8x, which has now come down to 0.3x, which means that as companies do grow in size, right, their ability to access capital also goes up, and which in a way do also helps in companies sort of deleveraging in a very, very right manner, and to that extent, even overall risk, aspect because of the delivered balance sheet also comes down over time. This is like CY 14 to 19. If you try to compare the earnings part of it, this was a relatively bad phase for the market where because earnings consistently keeps on getting downgraded, right? So these 5 years large cap earnings has hardly grown. Like 5-year CAGR has been 2%, while at the same time mid caps has grown 7% sort of a CAGR, 14 to 19. Small cap and all because of base effect is looking very, very high number. But the point I want to want to mention is that at any given point in time, reasonable 5 years sort of a time horizon, earnings of mid cap and small cap can easily outpace large cap earning growth by at least 4 to 5% CAGR, and which is a very, very significantly higher number. Similarly, you look into, let's say, from CY 20 to CY 25 is now more or less done. This like due to COVID and all the impact has been there, but since then clearly the one thing has changed and which has also dropped market post-COVID is that pretty good consistent sort of earnings recovery, right? Even large caps has also delivered pretty good mid-teen sort of earnings growth post-COVID. And if you try to look into the mid-cap, earnings growth again has been far higher than that of large cap. So what again I'm trying to say is that given now company size and scale has gone up multifold, so overall even the risk proportion of it is also sort of coming down with pretty good return ratios as the balance sheets has got delivered. There is a now pretty good, better sort of a predictability of these companies sort of delivering pretty good mid-teen sort of earnings CAGR. And even if you try to look into going forward as well, the earnings expectations are again pretty healthy mid-teen sort of a CAGR. Currently, last 2-3 quarters now we are in a phase of bit of an earnings downgrade. That's why. But even after that, if you try to look into next couple of years, large cap earnings growth is like 12-13% expectation, while mid cap and small cap earnings growth expectations still remains very, very high at around 20% sort of a CAGR. Now let's try to discuss some of the structural investment themes where we do see a lot of opportunities and a pretty good sort of earning compounding from the visibility standpoint. One is onto the consumption side of it, more so consumer discretionary. As we see that India is a very young demography with median age 29-30 years of age. So clearly, as the per capita income is sort of seeing a jump up, maybe in line with at least the nominal GDP growth, which is 10% CAGR. Currently, we are at maybe $2,400 as such. But clearly, if you try to take cues from the Western world, $3,000, sort of inflection point, right? We are more or less there. So in that context, as the per capita income catches up to $3,000. a lot of spending, significant incremental share of wallet clearly goes into the discretionary spending side of it. So many of these businesses, while let's say incremental spending on the food side really does not go up that much in line with the higher per capita income, but across many of the other spaces, if you look into on the discretionary side, clothing, footwear, healthcare, transportation, travel, tourism, recreation, education. I mean, I think many of these sectors you clearly see a disproportionate spending over time. And we are clearly sitting at an inflection point in that case from the $3,000 per capita spend point, so which clearly do offer a significantly higher headroom for growth in many of these sectors, which fits into either you can say, let's say, consumer durable, discretionary, retail side of it. I mean, many of these businesses do clearly offer a pretty actually longer. Second is on the pharmaceutical side of it, and within that also the even more sort of exciting segment has been the contract research and the manufacturing side of it, which is we do call the CRDM, contract research and development, manufacturing side of it. One, if you try to look into clearly as the outsourcing sort of increasing, global CRDM industry is growing at a pretty good pace. I mean, if we try to look into global CRDMO industry is almost $200 billion. Last 5-year growth has been around 9% CAGR. And going forward also, if we try to look into the expectations are that this industry will keep on growing at almost 9% sort of a CAGR to reach almost $300 billion. Within this, if you look into some of these smaller biotech companies are also, has actually also seen pretty good sort of a funding time, right? So that's why their R&D spending is also going up. And if you try to look into, let's say, global R&D spend, which is growing at around 7-8% sort of CAGR, and within that, these relatively smaller pharma biotech companies are seeing their spending growing at a much faster pace. And that's why their ability to even outsource much more because of the cost advantage goes up. And where really fits in India in a very beautiful way that let me try to show the subsequent slide. But clearly the message here out is that top-down basis R&D spend is growing at around 7% CAGR. Within that, share of outsourcing is even growing at a faster pace. And because of this Biosecure Act, as well as the Indian CRDMO industry, we try to look into the expectation. It is as of now hardly $7 billion dollar. Like on a $200 billion global spend. We are at this point in time is hardly having 3% share. And the expectation is that this is going to grow at a 15% sort of a CAGR, and also because of if you try to look into due to global biosecurity, Indian players are seeing even much more sort of inquiry pipeline, and and actually benefits of that can clearly be reflected in India share going up because we have got all the right sort of a talent pool available here, clearly cost advantages being there. So and also there has been a pretty good history around India sort of pharmaceutical industry as such. So here, also if you look into the China share, which has gone 10-11% is expected to come down because of, again, Biosecure Act, pretty good China plus one story has out here. To capitalize on this, if you look into the many companies' share of capex has also been going up. If you look into, let's say, on a 2-year average basis, if we try to look into the capex number, which used to be around $700-800 million, has now almost gone to 1.3 billion per year basis. So to that extent, I think this again remains a very exciting space which can offer a pretty good mid-teen growth CAGR going forward. This another theme has been this India electronics manufacturing EMS space, which has been very high growth sort of a segment, and the way government is trying to capitalize on this. One, to reduce the import substitution. Second, try to capitalize on the export side of it. I think it is building up in a actually very good way with pretty right support of the government through PLI as well as the capex rebate schemes as such. And then if you try to look into the idea is that to increase electronics manufacturing by almost $300 odd billion, including the export, where share of exports has to rise many fold. We have already seen pretty good success from the mobile, manufacturing, mobile manufacturing side of it, which has almost seen a production jump of 4x from $30 odd billion to actually $126 odd billion. And this is what the government targets are to reach this overall electronic production to almost $300 odd billion. So here, at this point in time, India again is having a very minuscule share of 3 to 4 odd percent of global CMS, global EMS sector. And which the only advantage earlier used to be the cost side of it, which with government support, if we try to look into all these schemes put together are giving support to the tune of 7 to 8 odd percent, 4 to 6% by way of PLI schemes, and then there are various other schemes. So all of these things put together comes at around 8 odd percent versus China, and we try to look into this has been the cost of it disadvantage, right? 7-8 odd percent, which is by way of let's say raw material, because India is still the entire component ecosystem is not being there, it's still on the RM side. Costing is higher versus the China, but by way of many of these schemes, as size goes up, even component ecosystem developing, I think fitting in very good from the from the costing point of view. And we have already been seeing actually pretty good success sign of this with actually many of these companies growing a very faster sort of a growth as such. This another theme has been this entire energy transition, which if you look into as the India, if you look into, let's say, even the manufacturing share of India GDP has to go up, and even a lot more power consumption is coming by way of newer business application, AI, artificial intelligence, data centers, and all, right? Overall, the power growth, which has been, let's say, in last decade, might have grown at around 4 odd percent, 4.5%. The expectation is that this actually has to grow at least 6-7% sort of a CAGR going forward. And within this, clearly, as a result of energy transition, a lot more investment is happening on the renewable side of it. And there, if you like to look into clearly, this gray bar is more like thermal sort of a capacity addition, which expectation is that is going to remain flat, maybe very marginal sort of a growth. Clearly, because of the decarbonization, renewable side investments has to go up in a meaningful way. And within that, if you try to look into solar and then this wind side of it is going to see a much faster growth. We have already been seeing that a lot more investment is happening in this particular space, and not only onto the IPP side, because of higher growth in many of these segments like solar plus wind is almost 17% CAGR from 23 to 30. And as a result of this, even this entire energy transition value chain, we have been seeing a lot more investments happening around here. If you look into, let's say, on this entire chain manufacturing side, we have been seeing a lot more investment onto the module manufacturing, WTG, which is wind turbine generator manufacturing. Then one more step of backward integration around battery manufacturing. So many of these areas are seeing a significant investment. And and I think with the right sort of growth profile being in place, at the same time, government again trying to putting in to develop domestic ecosystem. They are trying to put in a lot of tariffs to actually reduce cheaper imports. And as a result of that, they are also making sure that industry, whatever is putting up capacity, they also to keep on earning a decent sort of ROI of their investments. So if you try to look into across the value chain, significant investments happening. These are like some of the numbers which are which at every value chain, manufacturing side we discussed about, generation development side, because again, if you try to look into 1 megawatt of solar is like 5.5 crore sort of an investment, and then we are talking about almost 150 gigawatt new capacity coming in. You can really see how much investment has to go into this particular energy transition. And then if you look into, because to evacuate all of those generation, a lot of investment is happening onto the transmission and distribution side of it as well. So a lot more companies within this space is also it's actually also getting a lot lot more ordering. And then there are like newer use cases which are like maybe 5, 7, 10 years ahead. Some of those areas are also going to see a lot more investment, maybe green hydrogen. EV we have already started seeing built up penetration out there. There's another, last theme which I'm talking about is on the logistics side of it. It has been about a scale play onto the improving infrastructure. As we see that, infrastructure, has improved significantly all over the country, right? Not only roads, railways, DFC commissioning, we have been seeing that there has been improved infrastructure. Now in fact, government is trying to struggle that we are more to add roads, right? That's why if you look into the budget and all, maybe the total budgetary outlay towards roads, expressway and all is sort of flat because they are not even able to now identify any incremental newer projects which can significantly add on to the infrastructure. Because of improving infrastructure, there is enough and more headroom for India logistic cost, which is a very significantly higher, almost 30% of GDP. Which, almost 30% of GDP. While if you try to compare this with China and all numbers looks like China cost is higher, but then you have to look into the share of GDP as well, right? Because India manufacturing share is low, despite of that logistic cost as the GDP is higher, while China manufacturing share is far, far higher, despite of that logistic cost is almost similar to India. Because typically, as the manufacturing share goes up in a GDP, clearly the percentage is spent towards the logistics because you have to move around a lot more things from one place to another. That logistic cost also goes up significantly. But having said that, how the China logistic cost has fallen over time, from 17-18% they are right now around 14-15% of the GDP. India at this point in time, despite of lower manufacturing share in the GDP at around 23-24%, while government stated target is to increase this share, that cannot happen without logistic costs sort of coming down because this remains one of the key aspects from the cost effectiveness standpoint. And with improving infrastructure, we believe that there is a lot more scope out here. This is also a very, very fragmented sector, and because of fragmentation also, I think the cost inefficiencies are there in the system. And with improving infrastructure, I think many of the bigger players to offer to have enough sort of a headroom to really take benefit of this and try to bring in cost advantage and keep on gaining market share in a significant way. But these are like again various other sort of parameters where actually India gives schools versus others. So yes, we are like stack out decently well. It is not like it is very, very inefficient. But having said that, because of improving infra, on many of the counts there is a significant headroom to actually improve on this particular aspects as such. And with this Western, dedicated freight corridor sort of getting commissioned maybe in another year's time, clearly rail coefficient is going to go up. And as we know that rail freight percentage cost is clearly lower than the road freight. So to that extent, I think with the rail coefficient going up and all, there could be a significant cost savings out there, and many of these companies, many of the companies in this particular segment can see a significant benefit as such. Within logistics, another subsegment is around e-commerce side of it, where again, very strong longer sort of a runway for growth. Here, if we look into China, again, trying to compare with the China. They are spending around $1,200 billion onto the e-commerce side. This if you try to compare, versus the India, the share is, very, very good. Penetration-wise, we are maybe 7-8%. From the e-commerce penetration standpoint, versus China is almost 3x of that. So as again, I think, the shopping behavior and the spending pattern goes more towards the online side of it. There will again be a significant growth around this entire e-commerce logistics side as well. So very, very long pathway for growth out here. So I think these are like broadly 4 to 5 themes I've tried discussed, a lot more companies within this particular space are actually part of the maybe mid-cap universe far more, and actually looks very, very exciting from the, from the medium term standpoint. Yeah, thanks. That's it from my side.